Hey everybody, Dave here, Hidden Freedom, and welcome back to another video. In this video, I want to talk about whether I'd still fire, so financial independence, retire early, put an emphasis on the retire early part during a market crash. So, if you're not aware, I am looking to retire next year in April of 2022, and that's roughly about, what does my spreadsheet say? It's about 120 days, 125 days away or so. And, we could have a market crash. And somebody even asked this question quite a few months ago and said, would I still retire during a market crash? So that's what we're going to talk about in this video. So let's go ahead and get started. So there's still time left. The M1 is doing an amazing deal until the end of the year, so December 31st. If you open an account and deposit $100, you get $50 free, and I'll get $50 free. And I love those type of win-win situations. I don't normally promote stuff unless it's kind of a win-win scenario. So all you got to do is click on the link down in the description or the first pinned comment, deposit $100, open your M1 account, and you'll get $50, and that's good until the end of the year. If you're still interested in my spreadsheets that I feature in pretty much all the videos that I pretty much record and put out, including this video here, basically it goes until the end of the year, so December 31st. There's a discount code, and it's down in the first pinned comment or down in the description. Actually, I think it's just in the first pinned comment. So, and the code is Xmas 2021. You will get a discount on the spreadsheets, and that goes till the end of the year as well. All right, now that we got some of that stuff, housekeeping stuff out of the way, somebody asked this question, I don't even know how long ago it was, quite a while ago, said, hey Dave, would you still retire if there was a market crash? So that's an interesting question. I thought about it quite a bit, and I can't even really, what is a market crash, right? Is that, 20%? Is that 30%? Is that 10%? Is that 15%? Is that 50%, right? Like we had in 2008. And just to remind you, in 2020, that pullback was roughly about 37%. And it did not give anybody time to actually put money into the market, really. I took advantage of it, but really, too many people put too much money in and they didn't leave themselves enough room for the market to drop even more. And it is what it is. You learn lessons every time, so we had a 37% drop. People are looking for a V-shaped recovery, and that's what it did. People are looking for a W-shaped recovery. It didn't do that. It didn't double bottom either. So honestly, and a lot of my stocks were recovered within 60 days. And the Microsofts of the world and the Apples of the world recovered quite quickly. Took a lot longer for some stocks, and it depends on what the pandemic caused. Like CCL is a good example. Disney's a good example where those stocks are still hurting to this day. But there's a lot of stocks that took advantage of the pandemic as well. They did well, and honestly, a lot of stocks in my dividend portfolio were fine. There was only one dividend cut out of my entire portfolio, and that was Wells Fargo, so I cut them out of the portfolio. We'll probably get a cut on AT&T, but that really has nothing to do with the pandemic either. So just looking at my spreadsheet here, we're kind of just looking at the individual positions here. I do have some individual positions, but I did get out of a lot of those individual positions as well and went for some income ETFs down here. So I got Devo, NUSI, JEPI, QLD, and XYLD. And I actually have QQQ in here as well. I don't know where it is at the moment. It's kind of all over the place, but there's QQQ right there. I've been in and out of QQQ just because I've been selling puts against it. Not against it, but to get into it. So, and I've kind of been just dodging in and out of shares on the volatility that we've had recently. So, so what happened during the market crash, right? My portfolio was pretty defensive when it comes to, it was defensive when it came to the dividend portfolio. The individual stocks was pretty defensive. So now I'm in, a lot of XYLD, QLD, JEPI, NUSI, and Devo, and those might not be as defensive, okay? Now, I think Devo's pretty defensive. NUSI is defensive. It's got crash protection on it, right, with those protective puts. I'd say JEPI is pretty defensive as well. it probably wouldn't be as defensive as an individual stock portfolio made with blue chip stocks like I have in my portfolio here. And then you got XYLD and QYLD, which honestly are not defensive at all. And if the market drops 50%, your income is going to get cut. Probably, it could be 50%, who knows. But the rest of the stocks here, and I'm talking about really the income ETFs, Devo, for example, will continue to pay out pretty similar to what they're already paying here because, well, they're doing cover calls, so I'm assuming actually that it would drop a little bit now that I think about it. But the stocks in there, they're solid stocks that are in there. They're basically made up of individual, blue chip companies, or think of it like that in a way. But I guess the income kind of would drop a little bit just because they're doing covered calls opportunistically in there. And that could cut the income because if they have to sell below above their cost basis, I don't know if they're going to sell below their cost basis or not. Probably not. But, Nusi and JEPI, QYLD and XYLD, they kind of, I don't think, because it's cash settled, they're selling against the SPX or they're selling against the NDX. So they're kind of holding the stocks in their portfolio, but they're selling the puts or the calls against the NDX or the SPX. So they don't have to worry about the churn of getting positions called away. So I don't know technically if they'll sell below the cost basis. We don't even know what their cost basis is. It could be a lot lower, so it doesn't really matter. But, Nusi should hold up pretty well as well. And I think JEPI will hold up pretty well as well because it is a little bit lower volatility than S&P 500. And then you got all these individual positions up here, which should hold up pretty well as well. They're, a lot of them are lower beta. And a lot of them are just blue chip stocks. Now, if they drop, it doesn't mean that they're going to cut the dividend, okay? Like I said, out of all the stocks I had at the time, which was like 35 individual stocks, one dividend got cut, and that was on WFC, Wells Fargo. That's the only one ever got cut out of my dividend portfolio. So let's talk about the elephant in the room here. And my plan is to retire, and let's go to the other page here. Let's see here. Let's go to tools, and we'll look at this, numbers here, because this is kind of the projections of what everything's going to be invested in and the income I get from it. And by the way, right now, a lot of cash that's in my 401k, roughly about 40, let me see, about, I don't know, 70% or something like that is in cash. And then I got the solo 401k here. Most of that is in cash as well at the time because I'm getting ready to retire. I'm going to want to roll that capital over to an IRA. And then I'm also selling puts against the solo 401k QQQ to try to get reinvested back in that. Roughly about 10% down from where the current price is. And then you got the dividend portfolio over here, which I got individual stocks, which brings in about $3,000 a year. So I got all the income ETFs up here that bring in this amount right here. And then I got real estate notes that brings in roughly about $22,000 a year. I got options income, which I'm projecting at about 12% next year. Or maybe I'll even lower that. Who knows? Depends on how active I am. But all this capital here on the actual taxable side brings in $9,000. If I took the options out, that would be about $6,000 of income I still have coming in. So I can afford to take a hit. If the market drops, 20, 30, 40%, I can, because not everything, the whole portfolio is not going to drop 40%. I'm sitting in cash in some things. Those will be invested at some point down the road. Like I said, I'm doing options in those accounts over there. In the taxable account here, there's just some stuff in there that's not going to drop as much as the overall market. Options income, I can actually make money on a declining market, okay? Because I'm mostly just doing indexes in there as well. It's pretty safe, other than BABA, because I'm doing a BABA right now, and BABA's kind of just beating me up a little bit. But so to answer the question, I know this is a long answer here. To answer the question, I'm still going to retire whether or not we have a market pullback or a crash, because honestly, a crash is not going to be long-lived, in my opinion. If a crash is long-lived, we're going to have bigger issues going on in this country, in my opinion. And people are not going to worry about stocks. You're probably going to have to worry about something else. Just like if the market went to zero, people worry about, what if your stocks went to zero, you know? And it's like, if your stocks go down to zero, you better hope you have some brass in your closet. That's what I'm saying, right? If the stock market drops 40%, most likely it's not going to stay down there. There's a reason why, you know, Jay Powell dropped a bunch of helicopter money in the market, 37% down. Bring liquidity back to the market, right? And it just shot up from there. And now they're printing boatload of money, so it's just causing the market to go up from here. And that's the reason why I'm trying to stay invested as much as I possibly can, because I want to take advantage of that inflation, right? Otherwise, I'm actually losing money. But my plan is to retire next year, regardless of what the market is doing, and you know, go hike the AT first. If you haven't, you know, followed my other channel, go ahead and follow my other channel up here. I'll be talking about the AT over there and doing daily video over there on the AT, amongst traveling outside the country once I get back from the AT. So if you can support me on that channel, I'd appreciate it. So I'm gonna be living pretty cheap once I retire next year in 2022. I already have, you know, about $25,000 in cash sitting on the sides. And that'll partially go to the first few months in 2022, where I'm actually going to try to max out the 401k in the first 4 months. So I'll be living off a little bit of cash there, or kind of supplementing my income a little bit. And then when I retire and go hike the AT, I can live off of really cheap, you know, because I don't need a lot of money to live on the AT, right? I'm going to stay in hotels occasionally and then stay in the tent most of the time. And you know, it's like after I get back from the AT, I go live over the seas in Thailand, Vietnam, Philippines, Mexico, South America, where I can live on $20,000 to $30,000 a year. So if the market's pulling back, I'm going to be bringing in a lot more capital than I'm actually going to need to use. And guess what? I'm just going to reinvest that back into the dividend portfolio, or back into the FIRE portfolio, and take advantage if the market's down. Even if the market's not down, I'm still gonna reinvest into a bunch of positions as well. Start building out SCHD eventually as well, and then eventually down the road, you know, VTI or VOO, and continue to do my options and all that stuff. So down the road, like, I'm not worried about it. Like, people have asked the question, you know, would I still retire? What if my portfolio dropped to 1.5 million? And I'm not quite to 2 million yet. Matter of fact, I didn't even show this page right here, but I'm up 1.927 today. And so I'm roughly about, what, $63,000 away. Is that 60? No, 70. Excuse me, $73,000 away from $2 million, which is my goal. But if I don't hit my goal and the market drops, that's fine, because what it does when the market recovers, I'll be back at my goal, right? I don't need to hit that, you know, arbitrary number just to retire, because if the market drops, I'll reinvest back in the portfolio, and then when it recovers, I'll be back right where I was. In addition to that, I'll be even higher than where I was, right? So my number originally, you know, I don't know how many years ago now it was, several years ago now, 1.35. And then I moved it to 1.5, and now I'm at 1.9, and we already had a recession last year. We already had a crash last year. I don't think we're gonna get another one anytime soon. We're on the other side, we're on the downhill slope at this point. I think it's the perfect time to call it quits. So I don't know. Anyways, let me know what you're thinking down in the comments on what I said in this video. Would you still retire next year if you had $1.9 million and the market dropped, you know, 20-30%? To me, 20-30%, well, 20% is a nice good correction. There's a lot of capital sitting on the sidelines right now. $4 trillion sitting on the sidelines, ready to go back in the market. People are pouncing on every single pullback. People are pouncing on the market. And I am too. So, but I do have cash sitting around the sides, waiting to go in the market, selling puts against Qs and SPYs and IWMs eventually. And I'll generate income that way, and also get a discount if it does get assigned. And we'll play it that way. So let me know down in the comments what your thoughts are. Would you still retire or fire next year? And love to hear your comments. So Anyways, until next time, please go and like and subscribe. We'll see you in the next video. Thanks for watching.